When you're applying for a commercial loan, it's easy to get caught up in the interest rate. After all, it's the first thing everyone looks at, right? But here's the thing. The interest rate is just one piece of the puzzle. It's important, but it's not the only factor you should be considering when you're thinking about commercial financing. Let's talk about loan fees. These can include things like origination fees, processing fees, and closing costs. These fees can really add up and might surprise you if you're not paying attention. Always ask your lender to break down all the fees up front so you know exactly what you're paying for. Then there's the prepayment penalty. Some loans will actually charge extra if you pay them off early. It sounds a bit backwards, but it's true. Lenders do this to protect their own interest income. So if you think you might pay off the loan ahead of schedule, make sure that you know if there's a penalty for that. Now, let's talk about the amortization period and how it affects both your monthly payment and the total cost of the loan. So let's break down an example. Imagine you're taking out a $500,000 loan at 8% interest. If you choose a 10-year amortization period, your monthly payment will be about $6,065. And over the life of the loan, you'll pay about $227,000 in interest. Now, if you go with a 20-year amortization period, your monthly payment drops to $4,181, which might seem more manageable and would work better for cash flow. But here's the catch. Because the loan is stretched over a longer period, you'll end up paying about $502,000 in interest. That's more than double the interest you'd pay on the 10-year loan. So while a longer amortization period can lower your monthly payments, it significantly increases the total cost of the loan over time. It's all about finding the right balance between a manageable monthly payment and the overall cost of the loan. And don't forget about balloon payments. Some commercial loans are structured with something called a balloon payment, which is where you have a smaller payment amount during the term and then owe a larger sum at the end. This can really affect your business if you're not prepared to make that cash payment or you can't refinance the property. Understanding these factors, the fees, penalties, amortization periods, and payment schedules will help you make sure that you're making a smart decision for your business. Making sure that you ask the right questions and doing your homework before signing on the dotted line is critical. If you're not sure where to start, reach out for advice. We're here to help. Getting a clear understanding of your loan terms up front can save you from unexpected costs later and buyer's remorse.